If your wealth is stuck in rupees, you are playing a smaller game. That is not insult. That is macro reality. Most Indians earn in rupees, save in rupees, and invest in rupees. Measure success also in rupees. And most people never question that system. But here is the uncomfortable truth. The rupee has been weakening against the dollar for decades. Slowly, quietly, but consistently. 20 years ago, the dollar was around 45 rupees. Today, it is above 80. That is almost 2x move in the currency. That means the rupee has lost significant value relative to the dollar over time. Now let's understand what that means. Even if your Indian stock portfolio gives you 12% annually, your currency is slowly eroding against the global reserve currency. You're compounding inside a weakening base, and that matters because wealth is not just about percentage returns, it is about purchasing power. Let's break this down with numbers. Imagine you invest 10 lakhs in Indian equities. You earn 12% annually. After 10 years, that becomes roughly around 31 lakhs. Maybe that sounds great. Now, let's add currency reality. If the rupee weakens 4% annually against the dollar during that period, your global purchasing power does not even grow at 12%. It grows only close to 7 to 8% in terms to the dollar. That's the silent gap. You are doing well, but globally, your growth is reduced. Now, let's think long term. If you ever want to travel abroad, buy international assets, or invest in foreign markets, or send children to overseas, dollar strength matters. Now, let's shift. Crypto is priced globally in dollars. Bitcoin is quoted in US dollar. Ethereum is quoted in US dollar. Most major crypto assets are valued in the US dollar. When you buy crypto from India, you are converting rupees into dollar-based assets globally. You are stepping outside the rupee-only system, and this is where things change. Now, your wealth is not just dependent on Indian growth, it is exposed to global liquidity. This is why crypto feels powerful to many young Indians. It gives access. You don't need a US bank account. You don't need Wall Street connections. You convert INR to USD based global assets instantly. That is financial expansion. But let's not be emotional. Let's compare intelligently. Indian stocks represent businesses. They generate revenue, they have earnings, they grow with the Indian economy. Crypto is very different. It does not produce earnings like a company. It is driven by the value. What value? Network adoption, scarcity, liquidity cycles, market sentiments. So, this is not crypto replacing the stocks. This is about exposure. If you are 100% invested in Indian equities, you are 100% exposed to Indian economic growth, Indian policy, Indian currency. That is concentration risk. Diversification is not only about sectors. Now, let's build two portfolio scenarios. Scenario 1, 100% Indian equities, stable, domestic growth, fully exposed to INR. Scenario 2, 60% Indian equities, 30% goes to crypto, 10% gold or cash. Now, what happens? If the Indian market performs well, 60% of your capital benefits. If global liquidity expands and crypto runs, 30% you benefit from that. If rupee weakens, your dollar-based crypto offsets your currency erosion. Now your wealth exists in two systems, domestic and global. This is your structural advantage. Now let's talk about liquidity. Global markets move in cycles. When central banks print money, liquidity expands. Risk assets will rise. Stocks will rise. Crypto rises more aggressively. When liquidity tightens, risk assets will fall. Crypto falls faster. Why? Because crypto is more sensitive to global liquidity. It reacts faster to capital flow changes. This makes crypto volatile, but volatility is not the same as risk. Volatility is movement. risk is permanent capital loss. The real risk is overexposure without discipline. Now, let's address the elephant in the room. Crypto crashes. Yes, obviously. Now, it has dropped 50 to 70% in the past cycles. Stocks rarely crash that violently outside crisis. So, why consider crypto at all? Because long term liquidity expansion has historically been the trend. Because digital asset adoption is increasing. Because Bitcoin has a fixed supply of 21 million. No government can print more. Fiat currencies expand supply constantly. That structural difference matters. Scarcity plus global demand creates asymmetry. But asymmetry comes with volatility. That's the trade off. Now, let's address objections. What about regulation? India has regulated exchanges. Global governments are regulating, not banning. Regulation brings maturity. What if crypto goes to zero? Then your allocation strategy will protect you. If you allocate just 20 to 30%, your portfolio will survive. If you allocate 80 to 100%, you are gambling. This is not going about all in. This is about intelligent exposure. What about Indian stock growth? It is growing. India is growing. Demographics are growing. Infrastructure is also improving. Equities will likely perform long term, but that does not eliminate the currency risk which you are exposed to. Now, think psychologically. Why do many Indians hesitate with crypto? Because it feels foreign to them. Because volatility scares them. People are scared about volatility because traditional finance feels safer. Here's the irony. We already accept currency risk silently. We accept rupee depreciation quietly. That is also risk. It's just slow. That's it. Crypto risk is loud. Crypto erosion is silent. Both are real. Now, let's talk strategy. If you are under 35 earning in rupees with long-term horizon, you may consider this. 50 to 70% Indian equities, 20 to 30% crypto, 5 to 10% gold, cash for emergency. If you are conservative, 70 to 80% equities, 10 to 15% crypto, 10% gold. The point is not exact numbers. The point is international exposure. Wealth should not be accidental. It should be structured. Now let's bring this home. Crypto is not better than stocks. It is exciting. Crypto is strategically powerful because it gives dollar exposure. Stocks are powerful because they give businesses ownership. The intelligent investor does not choose one blindly. He understands the currency. He understands the liquidity cycle. He understands allocation. He understands discipline. The debate is not crypto versus stocks. The debate is, are you limiting your wealth to just one currency system? Are you expanding globally? If your income is already in rupees, why should your entire net worth also be into rupees? Think bigger. Play local and global. You need to play both local and global, not just local. And if you want to learn structured allocation, disciplined risk management, and capital growth strategy, join Jawaad Trading Academy, JTA. We don't chase hype. We build intelligent positioning because serious investors think in systems, not in trends. I'll see you guys in the next video. Thank you.